Hello everybody, glad to see you're all here. Welcome to Phoenix Trading Strategies. My name is Ricardo Menjivar. Today we are going to be talking about why are the banks using high frequency order flow as a weapon of mass destruction against the retail trader. A very strong statement, but at the same time a very true one. So we're going to do a lot of discovery today, or at least you're going to discover quite a bit of information that will make you change your perspective on how the trade is manipulated right now in the Forex. But that's okay, because there's a lot of measures that we can take to counter that. So glad to have you on board, and let's begin. Why is it important to understand high frequency order flow trading that has become the weapon of mass destruction used by the banks against the world of retail traders? In fact, this is the reason why traders can't seem to get an edge. You see, you don't have a chance in beating them unless you understand the protocol that has defined the way they trade and drive the markets. For that, you need the right information that will map out where the smart money is going, and Phoenix Trading Strategies has developed a process and strategy that provides cutting-edge solution that traders need in this new era of digital manipulation. I'm sure that just how this picture is confusing, this is the exact type of information manipulation that banks and market makers use to confuse retail traders. It has no beginning and it has no end. And when you look at charts, it's pretty much the same thing. If anything, when you look at this picture, it really causes, on a subconscious level, it makes you dizzy. Well, I'm sure that many of you have felt that's the way that the trade is. It makes you dizzy just the same. So before we continue, let's go over the disclaimer. Future stocks and spot currency trading have large potential rewards, but also large potential risk. You must be aware of the risk and be willing to accept them in order to invest in the futures, stocks, and Forex markets. Don't trade with money you can't afford to lose. This presentation is neither a solicitation nor an offer to buy, sell futures, stocks, or Forex. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this presentation or website. Past performance of indicators or methodology are not necessarily indicative of future results. So today we're going to go over a number of things that will lead you to one conclusion. Banks and market makers change the rules of the trading game all the time, but in this case it's even worse because they have counter-programmed most of the indicators and strategies that you're accustomed to using. That's why you can't seem to get an edge. Let's talk about the journey that everyone goes through with trading, because we all have a specific journey. At first, it's exciting to learn and read about trading the Forex and futures markets. The adrenaline rush of knowing that you may have found a way to make some money trading, it is exciting when you think about it. Then you start to take courses on trading, but they don't seem to answer the questions that you need answered as to what your real plan of action should be. How many of you have felt this way? Quite a bit. And please don't be afraid to answer. We've all been there. Let me ask you something. How many of you have tried using every common indicator out there? And by that I mean candlesticks, moving averages, MACD, stochastics, RSI, Elliott wave, Fibonacci levels, etc. How many of you have come to discover that you're always late and you just can't seem to get an edge on the trade? Oh, but wait, it gets better. Is it that you don't know how to find the right support and resistance levels correctly? When you look at this chart, the moving averages don't really give you an entry, and the candlesticks don't do that as well. The MACD, is always late, the RSI is late, the stochastic is late. So how can you rely on this information when it's just not leading you to a path of success? Now, in this journey, I'm sure that you have asked yourself these questions. Have you ever felt frustrated because you just can't seem to figure it out? Have you felt religious in the worst way because you felt God was punishing you with a trade? Ask yourself if you're a smart person and why this craft of trading is so confusing and yet so humbling. Am I reading the indicators the wrong way? Is fear and doubt clouding my mind? We all ask ourselves that question. Do I lack the discipline to stick to my trading strategy? Why can't I follow directions? And the last question is, do I need to see a psychologist to help me get rid of this depression? Because at the end of the day, that's what's happening. You just can't seem to wrap your head around it, and it becomes frustrating, just like this individual here. So who do you blame now? Who are the villains? The answer is the banks and market makers. Why? Because they've allowed an industry of education behind trading that simply has caused more confusion and disappointment to retail traders. And why do I say this? Because high frequency trading has become, in actuality, the weapon of mass destruction. But you've had to pay your dues and learn about support, resistance, moving averages, MACD, stochastics, RSI, Elliott wave, Fibonacci levels, to see that they don't work, at least not the way they used to. But oh wait, I'm exaggerating because the banks don't manipulate anything, even though they just gave 5 banks fines totaling 5.4 billion US dollars for foreign exchange manipulation. These traders called themselves the cartel, and they were all on Skype and just basically communicating with one another, manipulating the trade. So if they don't manipulate, then what do they do? Because all this time, they've been cheating everyone. So what is the missing link that will allow you to decode the bank's intent and put the whole puzzle together? Isn't that what we're here for? You have to understand that the structure of how and why they have created these super algorithms with specific requirements that manage risk and exposure for them, once this has been defined, then you will begin to understand why the trade unfolds the way it does, and you won't let fear and doubt cloud your mind any further because you will finally understand the institutional mindset. Phoenix Trading Strategies will help you remove fear and doubt from your decision process. Are you ready to begin to learn what the banks and market makers do in foreign exchange and currency futures? Let's begin by understanding why they do what they do and what we must do to no longer be victim to it. Who has heard of currency portfolio rebalancing? And be honest, if you haven't, it's okay. What is currency portfolio rebalancing? And why must you understand this theory before ever trading again, whether you're trading Forex or futures? Currency portfolio rebalancing is what the banks do every day. They try and maintain risk in balance. Now that's hard to do when the foreign exchange market is trading 24 hours a day for 5 days a week. And you are correct by thinking that it would take an army of financial engineers to design and monitor such a project. Well, truth be told, that is exactly what they do. They have divisions of financial engineers, divisions of economists, divisions of programmers monitoring. Now, although money is in constant motion, there are levels of risk that are reflected in the market based on how they drive the trade. For example, have you ever wondered why it has been to their advantage that the Forex does not have a centralized exchange where all volume is reported? Instead, it is made up from a network of banks that is no wonder you can never truly tell what the amount of volume they are using to move the market. Have you ever thought of that? It's incredible how they have used this to their advantage. Do you all agree that most traded currencies are below? I'm sure that you also agree that they are the most liquid. Do many of you agree? Everyone normally trades the 8 major currencies. The US dollar, the euro dollar, the British pound, the Swiss franc, the Japanese yen, the Canadian dollar, the Australian dollar, and the New Zealand dollar. Have you ever asked how the banks manage the risk and exposure when they trade these currencies and the pairs that are derived from them. Do any of you know what currency portfolio rebalancing truly is? This is a theory and a protocol that the banks design their algorithmic high-frequency trading and risk management around. We're going to go over the biggest secret that the banks and market makers don't want you to discover, because that would mean that you would be able to figure out what their decision process is before executing their traded plan. Isn't that what we're here for? So, when you really think about it, if you don't understand their protocol, how can you understand their traded plan? So what are the 28 potential crosses that can be created from these 8 majors? The US yen, the US Swiss, the US CAD, the Euro USD, the pound dollar, the Aussie dollar, the New Zealand US, the Euro pound, Euro Swiss, Euro Aussie, Euro New Zealand, Euro yen, Euro CAD, pound Swiss, pound yen, pound CAD, pound Aussie, pound New Zealand, Swiss yen, CAD Swiss, Aussie Swiss, New Zealand Swiss, CAD yen, Aussie CAD, New Zealand CAD, Aussie yen, New Zealand yen, Aussie New Zealand. That was a mouthful. These are all the 28 pairs that are derived from the 8 majors. Now, do currencies and other asset classes trade within a specific frequency of volume? The answer is yes. Here's an example of what that can visually mean to you. And sometimes, these are things that you never think about. However, if you really think about it, if you notice how these waves are constantly going to extremes and then coming back to the other extreme and yet this one in the middle is just in balance. In balance. Well, wouldn't it make sense that if the one that is at an extreme can't be sustained at that level too long, and that's why it has to be brought back into balance and then taken out of balance? This is a perfect example of what they do with currencies. They take them out of balance, bring them back into balance. Take them out of balance, bring them back into balance. Take them out of balance, bring them back into balance. And they do that with their volume activity. They'll strengthen and weaken currencies at their discretion. The problem is that you don't know which ones they're doing that to. Well, you're about to discover how. Here's an example of the frequency of 2 currencies that are trading. What this picture also shows is that they strengthen and weaken currencies against one another. One being the Australian dollar, signified by the red line, and the yellow one is described by the Canadian dollar. Well, what this is showing basically is that whenever they've taken the CAD out of balance and strengthened it, they've weakened the Australian dollar, and vice versa. Here they completely weakened the CAD and then they strengthened the Aussie dollar. So this actually shows you the frequency of how each individual currency is trading against the other. And that's something that most of you have never really thought about when trading the Forex. An interesting concept, an interesting theory, and one that you have to understand and wrap your head around. Here's an example of all the major pairs trading at a specific frequency against each other. What do you think this chart is doing? Well, let me tell you that this indicator portrays information based on how they take out of and bring currencies back into balance. So what this picture shows you is how banks take some currencies out of balance within the portfolio of 8 majors and then bring them back into balance. So each line is represented by a specific currency. The red, the Australian dollar, the orange, the British pound, the magenta, the Japanese yen, the turquoise, the US dollar, the yellow, the Canadian dollar, the green, the euro, the white, the Swiss, and the New Zealand, the blue. Well, if you notice here, this is a great example where they weakened the yen, but they couldn't sustain it at this level of weakness and had to bring it back into balance against a portfolio of 8. But at the same time, they had strengthened the New Zealand, the British pound, the US dollar, and the Canadian, and even the euro. And eventually they weakened all of them back into balance. Now, you see the same thing happen here. Again, they strengthen the Japanese yen against the Canadian, against the New Zealand, against the Swiss, against the euro. And what's happening here is that it's literally showing you, depicting a picture that they cannot sustain these levels of strength for a significant amount of time. Because if they did, then that would throw the whole market off. And so that is how currency portfolio rebalancing is actually done. Think of it this way. If you stretch a rubber band out, you can't hold it like that forever. Same concept here. They strengthen and weaken currencies in order to balance out the risk and exposure in the market. Now, how do you apply this concept to finding trades and good entries? Well, this indicator is only meant to show you that as some currencies are in balance, it is the ones that are out of balance that should be monitored to define a trade plan. I take you would agree to that. So why don't we talk about what you normally do and why it doesn't work anymore? Do you spend wasteless time in front of charts trying to make sense of support and resistance levels? I'm sure you do. Do you draw trend lines and try to interpret candlesticks or price bars? Do you look at moving averages, fib levels, MACD, Elliott wave, Bollinger Bands? And at the end, have you come to the conclusion that you're always late to the party using these old, outdated indicators? Well, here's an example of what you do. Let's talk about that. You know what I see here? Lines that don't amount to anything anymore because they don't give you an edge in forecasting the next trade. This is what you've been taught to learn and analyze. It's useless information now, and it doesn't work correctly anymore. So you're at a disadvantage because you're using outdated formulas that are based on moving averages, and they just simply don't work anymore because you're late and you can never really forecast what their next move is going to be. Trading has changed, and it has changed for the worst. So now you have to apply different methods to get ahead. So take a look at this picture. This picture maps out the price levels that they're defining that they are using to define their trade. The gold dots show you that they are about to bring in volume and momentum into this pair and drive it up. It also shows you that they have to rebalance and offset their risk to the downside before taking this trade long. They're doing this out of a higher time frame because they plan their trades out of hours in advance, not milliseconds before. The colored lines represent higher time frame support and resistance levels that were identified by the yellow gold power dots. So, would you agree that we're painting you a $1 million picture and trade that you can understand? Do you want to know why I added moving averages? I did so you could see that if I would have attempted to base my entry on that, I would have been late each time. Why? Because moving averages are based on price action, so they depend on how big the candles move. Well, in this case, if I would have depended on the moving averages, I would have never really taken this trade long. But these dots told me that this support level was valid and that they were not going to trade below it. Far from it, they were going to drive this up to the next level, which was right here. They went from level, as you can see, to level, came back, and then retested it again and went all the way back. And you even got a third opportunity to get in right here. Now, this is on a 45-minute time frame, so each dot and candle represents 45 minutes. Now, that is a tremendous amount of time to, number one, analyze the trade. Number two, define your stop loss, which would have been below this level and below this level. And number three, to define even your take profit target based on the levels that they were trading to. So in this case, they went long, broke through this level that they had previously used as a resistance level, and then went to the next level. So what we're showing you is a picture of a trade where they're going from level to level to level. Why? Because these are the price levels that they prioritize. These are the ones that they are using. They're not normal support and resistance levels that you're accustomed to drawing. The algorithm defines them based on their volume activity around those price levels. So you're getting information that normally you would never have. You're getting specific facts, you're getting structure, and a specific time to enter and even exit the trade, but definitely to define your entry. That's important here. So here's where it gets interesting. Who here has been told that you cannot use volume in trading Forex? Well, our powered out algorithm isolates their volume activity at those specific price levels. But wait a minute, how can I see their volume? Now that's a good question. So we created a proprietary volume indicator that synthetically creates their volume activity, which is a must-have tool. Otherwise, you can't see when they are doing their high-frequency trading and what the true intent of the trade is. That is valuable information. So you can see in panel 3, here at the bottom, right here, they're buying and selling volume. We show you how to interpret that volume when the power dots form, because that's when it truly matters. So each individual candle here, I can tell you the exact amount of volume that was represented by the buying volume versus the selling volume. And then we get the net, the cumulative volume. So when we teach you how to interpret this, it makes this picture even more clearer. What we're teaching you to do is very simple, ladies and gentlemen. It's called connect the dots. You did it when you were in grade school. You'll do it now. It's easy and simple. This is our volume indicator right here. And as you can see, it is not like any other volume indicator you've seen out there. But it gives you the real numbers behind each candle. And that's what matters. That's where you can see the manipulation, not beforehand. Now, would it be helpful if you had a tool that alerted you every time the power dots formed in different time frames so you could analyze and time your entry, stop loss, and take profit targets? That should be based on the fact that the banks have already defined their trade and plan of action. Can it get easier to analyze what pairs you should be concentrating on? The answer is yes. That is why we created the market analyzer that will alert you when the power dots form. So when the yellow power dots form, you're getting an alert right here. You can use different time frames for the market analyzer so that you don't have to waste time looking at analyzing at all 28 charts. It will guide you to the best 4 pairs to trade for the day or session. So would you agree that this type of information is a valuable asset? Because let me tell you something, I do not like to be a slave to the trade, and I certainly don't like to be in front of the computer 24/7 drawing lines and using useless indicators that aren't going to give me an edge. For me, this market analyzer has changed the way I trade because it makes my life easier. It alerts me the currencies that are in play. Now, this is on a 20-minute, but you can change it to a 10-minute, a 15, a 30-minute, a 60-minute, a 180-minute, a 240, a 480-minute, a 90-minute. It doesn't matter. A 300-minute. If you're trading higher time frames, this is a great tool. If you're trading lower time frames, this is a great tool. You just can't go wrong. Why? Because it's guiding you to the charts that you should be paying attention to. So, if you're ready, I'm ready. Are you ready for me to put it all together now? What are the steps to identify a trade? First step is to determine what time frames I want the market analyzer to identify potential trade setups. So if I'm looking for intraday trading, I will set up alerts on a 10, a 15, and a 30-minute time frame. Once I've identified the best pairs that are giving alerts, then I can go to the next step. Second step is to look at the FX radar indicator to see if any of those pairs show you which ones are out of balance before they are brought back into balance. Third step, go to the charts to see how the trade is set up with power dots and confirm if it is setting between the trend stop and trend dots to go in the direction that has been defined. Fourth step, confirm with the volume indicator that the high frequency trading in those candles are the power dots along with price action. And fifth step, make sure that the trade setup has given us an hour to an hour and a half to establish an entry, stop loss, and take profit target with pivot points in previous power dot levels. Step 6, enter the trade and go watch a movie. Go play golf. Go have coffee. Go have a life. Because you just took a trade that's going to play out in your favor. It's that simple. It doesn't get any easier than that. So by now, is it fair to say that you see the power of our technology in trading? Just remember that no one is more deserving of this information than you. It is what you've been missing all this time, but like everything in life, it requires the right tools, the right information, training, and practice. Now you know what you didn't know before. So get excited that you did discover this now, because this is your moment of truth. You have reached a final frontier of information that you didn't have before. Your hard work and sacrifice has brought you to this defining moment with Phoenix Trading Strategies. So by now, if you're asking yourself, how do I get involved to get these indicators and start to learn what the banks are doing to disguise their real trade instead of being victim to the trade that you will now look forward, instead you'll now look forward to the trade, then I will show you how to take action now. But let's go over a few trades. I think it's very important that you take a look at this. These are trades that I took, and this one we took actually this Monday, early in the morning. It was about, I'd like to say 9:30 a.m. Eastern time. This trade, the power dots formed, it was the only trade out of all 28 pairs that we found that was legit incredible. The only one. Now, this trade, we waited literally 1, 2, 3, 4, 5, 6 candles before we entered the trade. This is on a 10-minute, a whole hour. Did I not just say that normally we find and identify these trades and that give us an hour's worth of time to identify what the banks are doing? Let me pull this trade out so you can see it in a bigger version, because I think that you'll really appreciate it. It's the same trade, and I'll show you exactly where I closed. This is the candle that I closed. I had stated that it was going to go to 190.29. I got out at 190.22. Now, ask me how many pips from my entry. 51 pips in one trade. Now, this trade ended up moving actually 80 pips. That's okay. I got it from here. Why? Because we were able to define the real support level that was not going to be broken by the banks or their algorithms, because they have already defined those price levels that they are going to be trading away from. In this case, we identified it here in the 10-minute. They had hit this level before, but then it formed here. And so we waited all this in all these candles. You believe me, if I would have shown you the volume indicator, you would see the amount of high frequency trading that was taking place. But it was taking place because they were offsetting their risk and exposure to the downside before actually taking it long. That's really what happened. A unique trade, realistically, it didn't take us more than 20 minutes to analyze it and be done with it. If you would have had one standard lot on this 51 pips, you would have made $410, which is exactly what we did. Interesting, huh? Well, this same trade, you can see this is where our exit was. It's actually 51 pips, not 50. But it was a very defining trade. Why? Because the trend dots were trading away. As you can see, these dots here between the candles are trend dots. These little ones here are plus signs, and they are called a trend stop. The little purple or magenta dots, these are pivots. And so we use that along with the power dots to define the next levels. Well, in this case, this was in congestion, but they never ever attempted to trade below this level. Ever. Instead, they were trading away from it. And you can see right here, this is where it began. As soon as they pulled away, the trend dots pulled away and the candle started to trade above the trend dots, then at that point, I knew that this was going to go long. Why? Because it had already moved away from this level 40 pips. But go back and see it. The date is June 8th, 2015 on a 10-minute. And you'll see for yourself exactly what happened there. Now here's another trade. Now this one I took June 2nd, 2015. And this was on the euro yen, again, a 10-minute time frame. But they basically announced this level at the open. Now previously, the day before, they had used this price level here, which was a 90-minute level. And you can see the power dots formed here, and they went long, and they did not look back. Well, then they came here and formed here. Now this is hours, but then it formed again here. When it formed again here, and this was about, I'd like to say it was about, it's 2000 hours my time, which is Pacific. So I'd like to say that it was about midnight Eastern time when they started to form. That's all I needed. I didn't need anything else. So I went long. And by the time that I closed it in the morning, I was up approximately 150 pips. If you would have put one standard lot, you would have made $1,218 in one trade. Very simple. The levels were identified. The algorithm doesn't lie because it's mimicking the volume activity that the banks are doing around specific price levels and identifying that they will not be broken. You have it here, 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 and then there was no tomorrow because it went to the moon. It's that simple. Now I got another trade I want to show you because I think it's very, very important to see. And this one is one that I did, let me see, this one was June 9th. And this was in the evening, of course. But I want to show you this because it shows the same trade that I did before the day before during the US session, which was here, but this is on a 15-minute, and you can see how I went long here and got out right here. These were my 51 pips. But here I drew the levels that they were going to go to based on what the algorithm had defined in higher time frames. So you're going to learn how to map the levels that they're using, the price levels that they're really using to map out their trade. These are the real support and resistance levels. This is no joke, ladies and gentlemen. This is where it gets interesting. Let me show you something. See this level right here, 190.60? This level is identified by the 120 level, by the 120 minute. Now, I drew this line here because we had power dots that formed on the 60-minute, and then we had power dots that formed on the 30-minute right here. So I drew this other line. I want you to look very carefully how they went up, hit it, never traded, and broke above it, and then pulled right back down to this level. Then they went up again, tested it, never broke above it, came right back down. One more time, tested it, failed, and came right back down. My entry was right here. It never went against me more than 15 pips. Now this is a pound CAD. By the time I got out in the morning, because I put this trade literally, it was approximately 1 a.m. in the morning Eastern time when I did put this trade on. But I want you to look at the final result. They went from level to level to level to level to level and then some. 153 pip trade. If you would have had one center lot, you would have made $1,214, which is exactly what we're displaying here. Why? Because we took this trade here and we knew that they were going to go from level to level. I was expecting it to come here. I never expected it to go below, so the fact that it went below was a bonus. But my expectation is that they were gonna go just like they went up here, come right back down to this level. Instead, they went further, which was even better for me. So hopefully, this has depicted what you need to see. This is giving you information, structured information that you need. Now, if you look at the moving averages here, would I have ever made my decision to take this trade short off of moving averages without really understanding the price levels that they were not going to violate because their algorithm had defined to, number one, if you notice, in all this time, you know what they did? They offset their risk to the upside because they weren't going to take it long. Their whole purpose in life at this moment was to take this thing short. But everyone that looked at this trade after this move said, oh no, this is going to go long. No. Our program guides you and tells you when you have levels of resistance in multiple time frames, there is no reason why you should go long. You have a pivot here, 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 telling you it's going to go short, and you have the price levels that have been identified. It's that easy. It's that simple. So if you're ready and if you're excited, I'm excited to help you. So it's very simple. If you want to learn how to trade the way the banks trade and see what they're doing, you got to buy now. You got to take action. So you can use this link. It'll take you to our cart and buy now. It's that simple. Tomorrow never comes. The more you think about it, the less you do, if you really think about it. What you need to do is very simple. You can go to our website at phoenixtradingstrategies.com, go to trading indicators, and where it says enroll today, where it says take action now, take action now. You can see we've basically described what each indicator does so that you can read it. Very interesting information. But at the end of the day, take action now. This is what one of my students has said. As a Forex trader for the past 6 years, I did notice that I was almost always late in my trade entries, but not anymore. Because we are trading risk, and the Phoenix trading method minimizes that to an unbelievable minimum. Finally, I must say a big thank you for changing the way I trade forever and accommodating my requests, as this software works and I believe that I can trust it 100% for my financial future. And this is from a student that trades a tremendous amount of lots and makes a tremendous amount of money daily. So take action now. This is what you get for the full package. The full indicator suite and training package is only $38.97. If you pay it in a single payment, you save $300. If you want a 3-payment option, the first payment is $19.97 today, and then you will be billed for 2 additional payments of $9.50 in 30-day intervals. Start now. Enroll now. Don't wait any further. And if you want to contact us, feel free. My email, or our emails here, are info@phoenixtradingstrategies.com. Or you can email me directly, ricardo@phoenixtradingstrategies.com. My phone number is 818-431-1357. Thank you for joining us today. I look forward to helping you. Have a great day.